In this video, we're going to look at some different purchase transactions by Sydney Retailing in Part 1 of Exercise 4.7 and 4.20 and how they would be handled under both the periodic inventory system and the perpetual inventory system, so you can see some similarities and differences between the two systems. I will note a separate video is going to cover the sales transactions, or Part 2 of both these problems by Troy Wholesalers. So just before we jump in, I find that a lot of people have trouble understanding just the conceptual difference between the two systems. So I'm going to go through that very quickly. Our perpetual inventory system is one where the cost of each item of inventory when we buy it is going to be recorded in the merchandise inventory account. So we're going to debit the asset account when we purchase it. As we're selling that inventory, we're going to transfer that cost from the merchandise inventory to cost of goods sold, which is an expense on the income statement. At any point in time where it gets its name of perpetual inventory system, we should be able to look at our merchandise inventory account, and it represents the cost of items that are still at our company on our shelves, ready and available for sale. On the other hand, our balance and cost of goods sold on our income statement should equal the cost of merchandise actually sold to customers. On the other hand, our periodic inventory system, it doesn't keep the detailed records. It doesn't show the continuous ins and outs of the inventory account. The only time at which the merchandise inventory account is accurate is when we're actually doing a physical count and valuing the inventory. Where it got its name is only periodically. Typically, that's something we might do once at the end of the year, once at the end of the quarter, at the end of the month, but only something that we do periodically. So let's go ahead and jump in to the first part of exercise 4.7 and 4.20 and look at how a typical purchase works. Again, keep in mind, in this video, we're only showing the transactions of the buyer, Sydney Retailing. On May 11th, Sydney is going to purchase $50,000 worth of merchandise on account. We have terms, 310 net 90. That 310 represents what we call purchase discount. In this particular case, if Sydney pays within 10 days, that's a 10 part, they get a 3% discount. 3% of $50,000 is $1,500, so they can knock $1,500 off the bill if they pay within 10 days. If not, then the total amount, which is $50,000, is due within 90 days. That's a net 90. The purpose of a purchase discount is to encourage early payment. So let's first look at the perpetual system under Part 1 of Exercise 4.7. In that scenario, we debit or increase merchandise inventory and credit or increase accounts payable both for $50,000. Keep in mind, at the time of purchase, we completely ignore that possible 3% discount because there's no assurance we're actually going to pay it within the 10-day discount period. Sydney would wait until it actually knows it's making that payment within the discount period to record the discount. And if we posted these entries to the general ledger, I know it's not a required part of the problem, but I think it helps to demonstrate the similarities and differences between the two systems. We can see that the merchandise inventory account balance has been updated for the $50,000 amount we purchased. We are actually achieving that perpetual inventory balance because this corresponds to what the company has on hand available to sell. So let's think about this. What about the periodic inventory system? It doesn't keep that up-to-date inventory balance. So what do you think is similar and different between the entries under periodic and perpetual? So it makes sense that we're still going to debit accounts payable because Sydney is still buying the items on account, on credit. But what about the debit? You know by now we've got to have a debit, right? Instead, under exercise 4.20, which is the periodic side, our debit is going to be an account called purchases versus merchandise inventory. The sole purpose of the purchases account is to accumulate the total cost of merchandise purchased for resale for a specific period. Important thing is we call it a temporary account because it does not ever appear on any financial statements. If we debited merchandise inventory, the account would just continue to grow indefinitely under the periodic inventory system since we're not reducing the account when we actually sell it. So let's move on to another important point on May 11th. You'll also note that Sydney also pays $500 cash to Express Shipping for delivery charges on the merchandise. Keep in mind the goods were shipped to the company with the terms FOB shipping point. Because of that, if you recall from your Learn Smart, that means title transferred from Troy to Sydney immediately at the dock. That means that Sydney is responsible for paying the shipping cost. In a perpetual inventory system, we're going to include a debit to merchandise inventory for $500 and a credit to cash for $500. Keep in mind, this is not an account. We're actually paying this off. You'll see this in italics. Keep in mind, the way our book and you'd be expected for the problem sets exam extra credit is you would debit merchandise inventory. Some companies, I wanted to mention just this for real life, do track inbound freight in a separate temporary account, even for a perpetual inventory system. And sometimes they call that account freight in or transportation in. And that's why I just showed it in italics. Again, don't have to know for the exam, but it's something just to know for the real world. After we post this particular entry, we see that the transportation costs to get the items to the company are now included in the cost of merchandise inventory. $50,000 plus $500 is $50,500. In perpetual, we want to show everything related to buying those items and getting them to us to be able to sell to our customers, and that includes transportation costs if under the FOB shipping point terms. On the other hand, in a periodic inventory system, the cost is instead charged to a temporary account called transportation in, or some companies call it freight in. We use transportation in, which is similar to the purchases account in that it's a temporary account. So let's continue to move on. And keep in mind, we have a return situation here, and merchandisers like Troy often have to deal with returns of inventory and also allowances. And I think most understand what a return is. Allowances can be a little bit more tricky. Allowance is just a price reduction granted to a customer because of perhaps some quality issue. So it might be given because maybe there's a slight defect in the merchandise, but the customer will still keep it. You're just trying to make them happy, or maybe it arrived late, and so again, you're just trying to get them to keep it and give them a little reduction in order for them to be happy. In this case, the customer ends up keeping the merchandise and just gets some type of price reduction. A return, like in this scenario, on the other hand, refers to merchandise a buyer actually physically gives back to the seller. So let's take a look at how a purchase return would be recorded in a perpetual inventory system. What do you think the entry would be on May the 12th if Sydney returned $4,000 of the merchandise to its supplier, Troy? The entry would include a debit to accounts payable for $4,000 because we've got to reduce it. We're also crediting merchandise inventory for $4,000 to also reduce it. After we post this particular entry, we see that our $46,500 balance in merchandise inventory is a combination of our original $50,000 purchase, $500 for freight, minus the $4,000 return. Keep in mind, we completely ignore that $2,400 cost of the goods for Troy because it's irrelevant for purposes of Sydney what Troy originally paid for these goods. Under our periodic inventory system in exercise 4-20, we're going to still debit accounts payable for $4,000 to reduce it for the return. On the other hand, we're going to credit a temporary account called purchases, returns, and allowances. Purchases, returns, and allowances is, hold on, I know you hate contra accounts. It's a contra purchases account. So that means it's related to purchases, which is a temporary account, but it has opposite the normal balance. Purchases has a debit balance, purchases, returns, allowance has a normal credit balance. Purchases, returns, allowances is deducted from purchases to arrive at net purchases for the period. Most companies with periodic inventory system prefer to show their purchases in purchases account and record any returns and allowances in a separate account, like purchase returns and allowances, because they're wanting to keep track of the dollar amount of defective product being returned to their suppliers separate from the original purchase. They'll typically have both of those accounts. Let's continue to move on. On May the 20th, Sydney is going to pay the amount owed to Troy. Keep in mind that this is on May the 20th. The original purchase was May 11th, that this is within the 10-day discount period. To calculate the amount paid, we first have to calculate the amount due by taking our $50,000 original purchase, subtracting from that the $4,000 return to come up with the total amount due of $46,000. You may have noticed that we didn't include the $500 freight cost for two different reasons. One, if you recall, it was already paid, so it's not still owed. The second, even if that hadn't occurred, keep in mind that amount is owed to a separate freight carrier. It's not owed to Troy, so there's no discount we can calculate on it. Since May the 20th is within that 10-day discount period from May 11th, we're going to subtract the 3% discount amount of $1,380. 46,000 times 3% equals 1,380. From the amount due of $46,000 leaves us with the actual cash payment for Sydney to Troy of $44,620. So let's continue to move on to the journal entry. First, in our perpetual inventory system on exercise 4.7, it's going to include a debit to accounts payable for the total amount due of $46,000. Going to move on to the credit to cash for now. Credit to cash of $44,620, which is the original amount less the discount. And also last and not least, to balance out this entry, a credit to merchandise inventory for $1,380, which corresponds to the 3% discount. After we post this particular entry, we can see that our merchandise inventory account balance has been reduced to $45,120, showing the reduction in costs related to paying within the discount period. And I think that a lot struggle with that hey, I'm not actually physically returning something out of my inventory, but the merchandise inventory account reflects not only the physical amount of the goods, but the cost of those goods. And in essence, we're having a discount, so we need to show reduction in that overall value, what's remaining. I'll also point out our accounts payable balance of $0 indicate that Sydney now has no outstanding payables. A lot of times I find that in this journal entry, there's a tendency to want to debit accounts payable for $44,620. Unfortunately, if you did that, you would leave an outstanding balance in accounts payable $1,380. You'd make it look like Sydney still owes Troy something, even though they paid in full. In our periodic inventory system in exercise 420, on the other hand, you would credit the temporary account purchases discount. So everything else the same, the debit to accounts payable, the credit to cash, but instead of crediting merchandise inventory, we credit purchases discounts for $1,380. Like purchases, returns, and allowances, purchases discounts is a contra purchases account with a normal credit balance. If we take the $50,000 purchase plus the $500 transportation in, minus the $4,000 purchases, returns, and allowances, and also minus the purchases discount of $1,380, we come up with an overall net purchase amount of $45,120. You might say, well, that corresponds to merchandise inventory. That's coincidental in this scenario because we have not yet made a sale. Just a complete coincidence. Talking about sales, we're going to have a separate video that's going to show the sales transactions for Troy, what journal entries they would record under perpetual and periodic in a separate video.